Hello everyone, this is Amit Kumar Singh. Now, welcome to the another one more session on future contract. So, in last session, I have just introduced what future contract is all about. So, future contract is the kind of forward contract which is basically trading over the exchange. So I hope you have understood the need of future contract. So probably during 1848, the group of farmers and trader they came together and they created a medium called CBOT, Chicago Board of Trade, where a new kind of forward contract which can be traded, and that was called as future contract. Now, the reason why forward contract was replaced with future contract was to avoid the possibility of default risk. Now, come in your mind how future contract can create a possibility where default risk can be avoided. So the to understand this question, to get the answer for this, you need to understand that the future contract is the kind of forward contract which is trading over the exchange. So if exchange is there, so there's a counterparty between the buyer and seller, and now the counterparty will decide the terms of the contract. Now buyer and seller cannot decide the terms of the contract. So future contract is basically it's exchange based a derivative instrument where the exchange decides the terms of the contract. Exchange decides which kind of commodity which can be traded over the exchange, what would be the maturity of the contract, what would be the size of one contract, everything would be decided over the exchange. Now in for example in India, the derivative instrument, the future contract which is trading over the Indian derivative market, over the Bombay Stock Exchange and National Stock Exchange, we have three kinds of contract: 1 month contract, 2 month contract, and 3 month contract. And all these contracts they expires on the last Thursday of every month. Hope you are understanding. So here you cannot decide the terms according to your convenience. What basically it's being done in the case of forward contract. So forward contract was basically it's a bilateral agreement where the long and short people they used to decide the terms of the contract based upon their convenience. But because the forward contract contains that the problem of default risk, that's why forward contract was replaced with the future contract. In India, when you talk about SCRA regulation, as per the RBI and SEBI regulation, you cannot trade on OTC based instrument. Normal individual cannot trade on OTC based instrument, and forward contract is a OTC based instrument. So over the Indian stock exchange, over the Indian derivative market, if any individual want to trade, they can only trade on futures and option segment. What are options? We'll discuss later on. Okay, so I hope you understood what is future contract is all about. So future contract is basically it's a forward contract which is trading over the exchange. Here the exchange determines the terms of the contract, and now the buyer need not need to worry who is the seller. The seller need not need to worry who is the buyer. Now the question come to your mind that how exchange make sure that the default does not happens. So remember one thing, in the case of future contract, when the buyer and the seller, the better word for buyer and seller would be long position holder and short position holder. So when the long position holder and short position holder they come to the exchange over a contract, so both the person have to deposit and money with the exchange, and that money is called as initial margin. So whenever you go to exchange and you ask for a future contract over some commodity, so you have to deposit a money to the exchange, and that money is called initial margin. So initial margin is the collateral with the long position holder and short position holder. Both the person have to submit to the exchange over the contract which they commit to do in the future based on the present determined condition. So when we talk about future contract, in the case of future contract, whenever the long position holder and the short position holder they come to the exchange and they talk about a contract with what they will do in the future, so both the person has to deposit an token amount or a collateral amount with the exchange, and that money is called initial margin. This initial margin is basically determined based upon the war on the underlying asset. War is basically it's a mathematical technique to measure the uncertainty over the underlying asset. If the uncertainty over the underlying asset is more, then the initial margin amount would be more. If the uncertainty over the underlying asset is less, then initial margin would be less. Maybe around 30 to 40% of the total value of the contract you have to deposit initially at forefront. Whenever the contract starts, that time only you have to deposit that money. so that in case if you default in the future, the other person would be given that amount from the your account. I hope you are understanding. So basically, when we talk about future contract, in the case of future contract, whenever the long and short position holder they come to the exchange, so amount which is decided, and that amount they have to pay to the exchange at the beginning of the contract only. Fine. So that amount is called as initial margin amount. So once the initial margin is being deposited by both long and short position holder, then the contract starts. Fine. So hope you are understanding this. So basically, when you talk about either financial derivative or we talked about either currency derivative, all the settlements what happens over the exchange, they all are basically cash based settlement. But in the case of commodity future contract or commodity option contract, because the underlying asset is a physical commodity, so along with the initial margin amount, what both the person has to deposit, they have to declare that at the later movement what kind of settlement they are looking for. Are they looking for physical settlement or they are looking for cash based settlement? Based upon that, initial margin can be changed. So I hope you are understanding this. So when we talk about future contract is basically it's a kind of forward contract where both the long and short position holder has to deposit an amount with the exchange. That money is called as initial margin, what they need to deposit to the exchange at the beginning of the contract. And once they deposited this money to the exchange, then what the exchange do, exchange every day at the end of every trading day, exchange do M2M settlement, that is called mark to market settlement over the underlying asset. And based upon the mark to market settlement, every day exchange debit or credit the money from your initial margin account to the other person margin amount. And that way exchange makes sure that the mark to market settlement happens every day. Now you would be wondering what this mark to market settlement. So we'll understand this with an example. So take the example where farmer and the trader, where the farmer told to the trader that farmer will give 10 kg of potato to the trader at 11 rupees per kg, and the trader told that he will buy 10 kg of potato from the farmer after 3 months at 11 rupees per kg. So the total value of the contract was 110 rupees. Okay, now on the, if the total value of contract was 110 rupees, and if you talk about the value, if you talk about the value, total value of the contract was 110 rupees. Now both the long and short position holder, they has to deposit some amount to the exchange. And now suppose the initial margin, based upon the underlying asset, we do this calculation. That VAR calculation little bit complicated to understand, there's no need to discuss that right now. So both the long and short position holder, they decided that they will give 30 rupees to the exchange at the beginning of the contract. And what happens, what everyday exchange will do, exchange will look into the price of this underlying asset. So the day when we went to the contract, that day the price of potato was 10 rupees per kg. Okay, and we decided that we'll do transaction after 3 months at 11 rupees per kg. So what exchange will do, exchange every day at the end of the trading hour, exchange will see what is the price of potato. If the price of potato become 11 rupees, it means if today is the settlement date and yesterday was the trading date, yesterday you decided to do at 11 rupees per kg and you decided on 10 rupees. So ultimately what will happen, that would be 1 rupees per kg gain to the long position holder, and 1 rupee per kg would be the loss of short position holder account. So what exchange will do, exchange 1 into 10 kg, that much money exchange will take out from the short position holder account and put into the long position holder account. So that way exchange every day look into the price of the underlying asset, and based upon that exchange debit and credit the money account to the other person account till the time if any of the person account touches something called maintenance margin. So maintenance, when you talk about maintenance margin is the minimum amount what need to maintain in the exchange. Suppose the maintenance margin is 10 rupees. So in any day if your account touches 10 rupees, then you get a margin call from your broker. And if you do not submit the money from 10 to 30 rupees, then that day only the trade will get seized off, and the other person will get the difference of the money as a profit, and that continue till the end of the contract, and ultimately on the end day of the contract the trade get executed. So when you talk about Basically the future contract, by using this concept of initial and maintenance margin, the exchange makes sure that the trade happens. Thank you everyone.